The great wealth transfer is underway. Question is, are you prepared for the taxes? I've got a few strategies you need to consider. That and more coming up. My name's Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. Are you prepared for the great wealth transfer? And if you're listening to this and you've heard of that before, you're like, yes, bring it on. I am ready. I am ready to receive an inheritance or two. And so listen, if you're not familiar with the great wealth transfer, take a look. It's underway. It's the greatest generation or silent generation and baby boomers. Over the next 2 decades, it's expected that $84 trillion will pass from those individuals to others, okay? And $72 trillion going directly to their heirs. That's a lot of money. That's a lot of money. Our finite brains cannot comprehend $1 trillion of anything. And let alone that much money being passed on from one generation to the next. Yeah, and again, because we're talking an inheritance or some dollars that aren't currently in your stewardship or in your responsibility right now, coming in your responsibility, oftentimes, if you set aside the emotions of that, oftentimes it's like, oh yeah, that's fantastic. Are you prepared? And one, prepared with the right financial habits, the right skills, maturity to be able to handle dollars that you didn't earn and work for, and the right preparation in all 6 areas of your financial life. We've done some shows on that here. Make sure you stay tuned here to the Wise Money Show and work with your CFP to get equipped in each of those areas. But specifically within the area of tax planning, are you prepared for the taxes? Now, what would be awful is if you receive a big inheritance and then Uncle Sam, your silent business partner, if you will, takes 30% of it. And I'm gonna say takes, even though no, taxes are due. It's sort of just a requirement in income and all that sort of stuff. But I'm gonna say take because maybe you could have done some proactive planning to minimize those taxes. And instead of having Uncle Sam take 30 or 40%, Uncle Sam takes 12 or 15 or 20% with the proper planning. Now, this preparation for the taxes is even more needed thanks to the new 10-year rule that was introduced in the Secure Act 1.0 that the IRS just officially interpreted this year and said this is how it's going to work. And it's almost as if Congress was implementing this new 10-year rule in advance of this great wave of transfer because as a mechanism to be able to generate more taxes. If we implement the new rule now, as that wave of transfers occurs, there will be more taxes that they'll be able to collect. And here's the thing, we're still on the cusp of whether the Tax Cut and Jobs Act taxes and tax rules will sunset in 2026 at the end of 25 or not. We'll see. That will obviously influence this. But the 10-year rule, if you inherit an IRA or a pre-tax retirement account from someone that's not your spouse, okay, and someone that is more than 10 years older than you are, then you are no longer allowed to just draw a minimum amount out of that account for the rest of your life and have that preserve that tax sheltering for the rest of your life. They used to call that a stretch IRA. If you have in the past received an inheritance from someone like that prior to 1/1 of 2020, you're grandfathered in. But for new dollars that you would inherit from someone passing away after 1/1 of 2020, you now have to withdraw the entire account within 10 years, accelerating that tax burden, accelerating when that income needs to land on your tax return, potentially pushing you into a higher tax bracket. Those rules, if you're not familiar with the recent interpretation, you have to take a required minimum distribution each and every year during those 10 years and still withdraw the entire account. So I'll say again, are you prepared for the taxes that will come with the great wealth transfer? Work with your certified financial planner and get proactive. Think ahead, plan ahead, and that way I'm confident you'll be able to come up with the right strategies to minimize the tax burden and keep more of this wealth in the family or in your pocket, helping you achieve your financial goals. Everything being equal or just sort of at a high level, what are some of those tax strategies you should consider right now in advance of potentially receiving an inheritance via this great wealth transfer. One, as you project out and build your multi-year tax projection and your retirement plan, you need to forecast and see, well, what tax bracket do I think I'll be in out there in the future when possibly my parents are in their mid to late 80s, something like that. And at that situation, depending on your tax bracket and whether you'll be at RMD or drawing Social Security and those sorts of things, it may make sense for you to then look backwards to today and say, you know what? We should shift our contributions from pre-tax into Roth, because if out there, when your folks are in their mid to late 80s, if you're receiving a chunk of pre-tax IRA dollars from them that you then are forced to start taking out a chunk out each year for 10 years and have the entire account emptied in 10 years, if you have more and more of your own dollars that can grow tax-free via the Roth, then you're going to be in a better position and hopefully stay in a lower tax bracket, avoiding the extra tax on your Social Security, IRMA, and those sorts of things. So maybe one of the strategies is you need to consider doing Roth contributions today instead of pre-tax. Doubling down on that, maybe you need to consider doing some Roth conversions for you, or maybe a Roth conversion for your folks. Not sure if you guys are open and discussing finances just yet. As they age and as you mature, you're going to want to have that conversation. It's, finances are private. Finances are not something you talk about at Thanksgiving, and it can create a lot of conflict and strife. And yet, if you don't plan, then oftentimes mistakes are made, or it's inefficient, there's additional costs and so on. And so hopefully your folks are working with a certified financial planner, or if you're a baby boomer and in this generation and will be on the giving side of the great wealth transfer, you're working with your CFP to explore these strategies. But a Roth conversion, both either for you, if you're planning for potentially receiving an inheritance, there again, having more of your dollars growing tax-free, because in retirement you'll be drawing out of the pre-tax inherited accounts early on, and you'll let your own dollars grow tax-free for longer in the Roth. But then also for those of you, or for your folks, for those of you that are potentially going to be passing on an inheritance, doing a Roth conversion now, if those dollars, any Roth dollars that you leave behind to the next generation, they still have to be withdrawn in 10 years, but it's not taxable. It's not going to push your beneficiaries into a higher tax bracket. So second strategy, Roth conversions. And then third, for those of you that have a high deductible, a qualifying high deductible health plan where you're eligible to contribute to an HSA, rethinking how you approach that HSA. Oftentimes, and just did a video on this, the 3 different ways you can approach your HSA. Oftentimes people think, well, how much do I expect to have in medical expenses for the upcoming year? That's how much I'll put in my HSA, and every time those expenses come up, I'll use my HSA. Sort of like a savings account, delayed spending account is what we would call it. But maybe you need to shift your thinking if you're expecting an inheritance, receiving an inheritance out there in the future in retirement that's going to cause you to potentially pay a lot more in taxes. Maybe you rethink and instead contribute as much as possible to the HSA. And then as medical expenses come up, don't draw from your HSA to cover them. Just cover the medical expenses out of pocket and save those receipts. So then out there in the future, you can reimburse yourself for those medical expenses that you could have taken from your HSA, reimburse yourself for them, and basically have that supplement your Social Security income or your income needed early in retirement, while you're also having to draw dollars out of this inherited account. Because as you reimburse yourself from your HSA for qualified medical expenses, it's not taxable. And that will help you limit the tax bracket that you're in, while also drawing dollars out via this new 10-year rule from the Great Wealth Transfer. Those are just a few of the strategies you need to consider, but tax planning is one of the 6 areas of your financial life. That's why I'm always going to tell you need to be working with a CFP that's doing comprehensive financial planning. If they're not doing comprehensive financial planning, they're not looking at all 6 areas of your financial life. But tax planning is all about looking forward, seeing what strategies exist for you to pay the least amount of tax over your lifetime, if not multiple lifetimes. So that includes having a strategy, having a plan, so that you can protect through this great wealth transfer, however it's going to be personal and impact you, how you can protect those dollars and that wealth that was hard-earned and saved up from excessive taxation. So work with your certified financial planner on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneysure.com. You can find us there as well, or send us an email, info@korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.